In this video, we're going to talk about Hycroft Mining Corp, trading under the ticker symbol HYMC. At this moment, the financial market is very volatile, and we should be careful about which stocks to buy and the exposure and timing of our trades. This video will cover the recent price actions and the technical aspects of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed and that it may not take into consideration the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's jump into today's topic. During the most recent trading session, the stock increased to $2.80 before closing the trading day at $2.30. We should pay attention to the $2 level nearby because it was tested as a support level, and what makes it interesting is that it has been a resistance level in the recent past as well. Over the past 30 days, the trend of the stock has been clearly bullish, and the stock is in the process of making new highs compared to the short and medium-term perspectives. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock is clearly bullish as well. And even if the volatility of the stock should not be understated, the trend is now very clear. Given the amount of trading happening outside of the exchanges, the short squeeze potential is also very present for HYMC in the weeks to come. When we look at the price trend overall, it has been speeding up, even if we should still expect some kind of retracement after such drastic takeoffs. But I think that this kind of moment has yet to arrive still. The trading volume of Hycroft Mining has recently been 114 million shares versus the average volume of 132 million shares. Over the previous 52-week period, its price fluctuated between 28 cents and $4.37. The market cap of Hycroft Mining is currently at $156 million versus the enterprise value of $229 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If it has a lot of debts or a negative image amongst market participants, the assets may be impaired. With that being said, at the end of the day, this is still an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note regarding the enterprise value is that for many growth type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it may have a better management, a stronger brand recognition, or a bigger online following. It is basically what is unique about a company compared to the alternatives. In other words, it may not be a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, since the market cap is lower than the enterprise value, and because the enterprise value tends to be less reactive to the market cap during very volatile situations. If the company goes to liquidation, the goodwill would be gone, and the shareholders and bondholders would have to share between each other whatever that is left on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 742% higher than the 1-month low, 742% higher than the 3-month low, and 742% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 246% versus the historical volatility of 474%. The put-call volume ratio is 0.09, and it is normal for many stocks to have a higher put option volume than what they deserve, as many institutional investors systematically hedge their positions by buying put options. The most recent volume of options traded is 43,000 contracts within a day versus the 30-day average of 38,000. In terms of open interest, The most recent volume of open interest is 200,000 contracts versus the 30-day average of 71,000 contracts. In terms of shareholder structure, institutional shareholders own about 10% of the outstanding shares. The biggest shareholders include White Box Advisors, Nomura Holdings, and Vanguard. It's relevant to understand the shareholder composition of a company because it helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. The consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as an investment and not just a trade position. This is obviously subject to a lot of exceptions, as many great companies can be held mostly by the retail investors as well, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes there are significant short interest in the total volume, and that can be a sign that there is an organized shorting operation going on, like what is going on with GameStop and Hymc. The current short interest is 30% of the total float, and almost 50% of it are coming out of the dark pools. My opinion on Hycroft mining overall is bullish, and I believe that in the weeks to come there may be new highs for the stock based on the amount of shares currently shorting Hymc and the magnitude of losses it previously had. The maximum exposure I would recommend is between 1 to 3% of your portfolio, and for the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are close to where it is. I would recommend to separate the allocation in batches of 10% at a time so that you may have enough room to buy later as well. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.